Hi, this is Aaron Andrew with Mist Fortune. What I want to go over with you today is the index loan feature that some of these products have. Now, I want to make sure that you've watched the fixed loan video because all these policies have a fixed loan and then some of them will have an index loan feature for you to use as well. So make sure you've watched that video. But just to review, we want to make sure that we understand that we're talking about how to access your money tax-free from an insurance contract, and that is found in Section 7702 of the Internal Revenue Code. And that's what allows us to be able to do this legally and take the money out tax-free. Now, so we're going to use an example that you have $100,000 in cash value inside a life insurance policy. And you want to be able to access that money and take some of the money out of it that you're earning in interest, but you want to take it out tax-free. Because money that goes into a life insurance policy, again, is after-tax dollars. The money you put in is after-tax dollars. The growth on the policy grows tax-deferred under Section 72E. And then we can access the growth tax-free under Section 7702, like I just mentioned. And the death benefit when you pass away blossoms to your heirs income tax-free under Section 101. All right, so first of all, let's go back to this $100,000 of cash value. And let's use an example that you have this cash value in your policy in an indexed universal life. And this indexed universal life policy is earning a guaranteed rate of 2%, is the example I'm going to use today. And you can earn as high as a 14% cap. Now, usually your return is linked to an index like the S&P 500. So our cash value over here is earning 2% up to 14%, depending upon what the S&P 500 does every year, and an average of about 8%. So 8% is the historical average that we see the last 20 to 30 years in these contracts. And some years, like 2008, we're going to earn the guarantee of 2. 2009, we earned the cap of 14. So it's going to bounce around there, but average of about 8. Now, when we want to take a loan against the policy to get our money out tax-free, let's say that you take a $10,000 loan. Now, if you have a savings account, let's say, or any investment account, a brokerage account, and you have $100,000 and you take out $10,000, you take that money out, you have a net of $90,000, right? Same thing here. We're just borrowing against it, but you're going to have a net of $90,000 because you have a lien against it. So first of all, let's draw a couple arrows here and show that you take a $10,000 loan. Over here on your cash value, you've got $10,000 that is earmarked to pay off that loan, and you've got $90,000 net. All right, so $90,000 net, just like I was mentioning a minute ago. So on the index loan, the neat thing about it is locked in stone at 6%. Now, also, some companies out there have what's called a variable loan. And the variable loan, this rate is going to fluctuate based upon the Moody's corporate bond yield. The nice thing is, in an index loan, this is fixed. So this is fixed at 6%, meaning it can't change, can't go up or down. And that's what you borrow at when you take money out of your insurance contract. Now, over here on your cash value, what's going to happen is that this full $100,000 earns the average of 8%. So this $10,000 earns 8%. This $90,000 earns 8%. So at the end of the year, your $10,000 that's in there that's earmarked for the loan is at $10,800. And over here, your loan balance is at $10,600. So again, your loan has grown to $10,600 because the interest, you don't actually pay the interest. They don't take this and pay the interest. This just accumulates. So the loan balance is at $10,600. Your cash value, this $10,000 is at $10,800. So you made a 2% positive spread, or a $200 spread on that money. So let's go back to the fixed loan. The other video that you should have watched, the fixed loan, you would have borrowed at, let's say, 3%, and this money earned 3%, so it's a zero-wash loan. That's the traditional conservative approach. This approach is real powerful because it allows your money to grow more, allows you to have more access to your cash value in this example. Because if we're averaging 8 on our money over here, and we're borrowing against that money at 6, we're making a 2% spread. But let's talk about the worst case scenario. Well, the worst case scenario is our cash value might only earn the 2% guarantee, like it did in 2008. Well, you still borrowed at 6, right? So over here, that's a negative 4% spread. So at the end of the year, this is still 10,600. This over here is 10,200. Now that's just 1 year. So you have to remember that this has gone up a little bit. The cash value, this is, and the $90,000 earns as well the 2%. But isolating this $10,000, that was a negative 4% spread. Now let's talk about if it can earn as high as 14. So if it earns 14 the next year, well, that money earns 14%. This is still charged 6. So in the long term, we are going to have a nice, spread of about 2%. Because we're going to average 8 over here. So we're going to have a nice 2% spread between these two accounts. So make sure that when we show you the illustration, that you see the difference. You see one illustration showing you taking the fixed loan, where it's the conservative approach in the other video, and then the index loan, a little bit more aggressive, but a powerful approach where you borrow at 6% and allow your cash value to still earn the index return of 2 to 14%. And in that example, it allows you to take out a lot more income. And the other thing, too, is you always can remember that you can pay back some of this loan. If you come into a windfall or an inheritance and you want to pay back some of that loan, you can pay it back. It increases your cash value that much more that you have access to. So that's the powerful thing, too, about the insurance contracts. You can borrow from these things for a car, for college, for retirement, and then if you want to, you can always pay it back. You borrowed at 6 against your money, and your money earned 8. That's a nice thing to have a 2% spread still on your money. So that's how the index loan works in these contracts, which is one of our favorite features, is to have that feature in your policy. And you can switch between the fixed loan and the index loan as well on an annual basis. Currently, they allow you to switch between those two loan features. And that sums it up. So that's the index loan and how it works inside the indexed universal life contracts.